Interest rates are too high, I'm going to wait until they come down. I hear this almost every day, and I get it. 7%, 6.5% sounds scary compared to 3% rates your friends locked in a few years ago. But here's what nobody is showing you. Even at 7%, buying a home right now is almost certainly better than contributing to rent. And I'm not just gonna tell you that, I'm going to prove it to you with actual math. I'm Dustin Hutley, I'm a loan originator in Southwest Washington, and today I'm going to break down the real numbers that everyone ignores when they say rates are too high. And by the end of this video, you're going to see the decision to rent completely differently. Let's start with something that might be uncomfortable to hear. When people say, I'm waiting for rates to drop, what they're often really saying is, I'm scared to make a big financial decision and rates give me a socially acceptable excuse to wait. I don't say that to be harsh, I say it because I've had hundreds of conversations with people who use rates as the reason to delay, and when we actually look at the numbers, rates weren't the real issue at all. Fear was the real issue. Uncertainty was the real issue. Not having clear information was the real issue. So let's get clear information. Let's run the actual numbers. I'm going to compare two scenarios for you. In both scenarios, we're looking at a family who currently pays $2,200 a month in rent, which is about average for a decent apartment or rental house in the Vancouver, Portland metro area. Scenario one, they decided to wait. They're hoping rates drop to 5% before they buy. Scenario two, they buy now at a 7% rate on a $425,000 home. Let's see what happens over the next 3 years. So for the record, by the time this video comes out, the truth is interest rates are actually closer to 6% right now, but I wanted to be really conservative in my approach when discussing interest rates, so we're using 7% as the floor here. In scenario one, the waiting scenario, they're paying $2,200 per month in rent. Over 3 years, that's $79,200 in rent payments. That money is completely gone. It didn't build any equity, didn't create any wealth. Their landlord appreciated it, but it did nothing for their family's financial future. Now, during those 3 years, let's say rates do come down. Let's be generous and say they drop to 5.5%. That's great news, right? But here's what else happened during those 3 years. Home prices went up. In this market, we've seen average appreciation of about 4 to 5% per year over the long term. Let's use 4% to be conservative. That $425,000 home is now worth approximately $478,000 after 3 years of appreciation. So yes, they get a lower rate, but they're also paying $53,000 more for the same house. And they already lost $79,200 in rent that built zero equity. They're over $130,000 in the hole compared to where they could have been. Now let's look at scenario two, buying now at 7%. Their monthly mortgage payment on a $425,000 home at 7%, including taxes and insurance and everything combined, is going to be somewhere around $2,800 to $3,000 a month. Yes, that's more than their rent, about $600 to $800 more per month. But here's what the payment is doing that rent doesn't do. Every single month, a portion of that payment goes toward principal. That's equity. That's their money. In the first year alone, they'll pay down around $4,500 in principal. By year three, they've built over $14,000 in equity just from their payments. And that's not counting appreciation. If the home appreciates at 4% annually, again, we're being conservative here, the same rate we used in scenario one, that $425,000 home is now worth $478,000. They didn't just build $14,000 in equity from payments, they gained $53,000 in equity from appreciation. Total equity after just 3 years is approximately $67,000. Meanwhile, the waiting family has zero equity and paid $79,200 in rent that's gone forever. But wait, what about the higher interest rate? Doesn't that cost more? Yes, the higher rate means you pay more interest, but here's the thing everyone forgets. You're not stuck with that rate forever. When rates drop, and they will eventually, then you refinance. You keep the house that you love at the price you locked in, but you get a new lower rate. I've helped clients refinance multiple times as rates shifted. It's a normal part of home ownership. The thing that's amazing, and I have a video about this where I talk specifically about being positioned, but when you own a home, you're positioned. That's the wonderful thing, is you now have the upper hand that when rates do drop, you get to capitalize on those rates with a refinance, and you're not in a competing market to try and get a home. So in scenario two, let's say rates drop to 5.5% after 3 years and they refinance. Now they have a $478,000 home that they only paid $425,000 for with a 5.5% rate with $67,000 in equity. The family that waited, they're just now buying that same house for $478,000 at the same 5.5% interest rate with zero equity and $79,200 less in their pocket from rent they'll never see again. Who's in the better position? Let me show you another way to think about this. Every month you rent, you're paying your landlord's mortgage. You're building their equity. You're funding their retirement, and you're getting nothing in return except a place to live temporarily. When you own, even at a higher rate, you're paying your own mortgage. You're building your own equity. You're funding your own future. Some of that payment goes to interest, but some of it goes to you. That's a fundamental shift that changes your entire financial trajectory. And here's something else nobody talks about: tax benefits. Mortgage interest is tax deductible. When you're paying rent, you get no tax benefit whatsoever. When you own, you can deduct that interest from your taxable income. For many homeowners, that's worth $3,000 to $5,000 or more per year in tax savings. Rent gives you zero tax benefits. Now, I want to be honest with you about something. I'm not saying buying is the right decision for everyone in every situation. There are times when renting makes sense. If you're about to relocate in a year, buying probably doesn't make sense if your job is unstable and you're not sure about your income. Waiting might be wise. If you have significant debt that needs to be addressed first, sometimes we need to prioritize that. I had a couple come to me about 18 months ago. Rates had just crossed 7% and they were nervous. They'd been approved at 6% a few months earlier and were pretty upset that rates had gone up. They were seriously considering waiting. We sat down and ran the numbers exactly like I just did with you. When they saw the comparison between buying now versus waiting, their whole perspective shifted. They bought a home at 7.125%. Fast forward to today. Their home has appreciated about $45,000. They've built about $9,000 in equity from their payments. They have $54,000 more in net worth than they did 18 months ago. Their friends who decided to wait, still renting, paid about $40,000 in rent during that time, zero equity, and the homes they were looking at now cost $40,000 more. Same starting point, different decisions, dramatically different results. So here's what I want you to take away from this. A 7% rate is not too high to buy a home. It's actually pretty normal historically. Waiting for rates to drop often costs more than buying at a higher rate now. The math almost always favors action over waiting. You can refinance when rates drop. You're not stuck with today's rate forever. Every month you rent is money that's gone forever. Every month you own is equity you're building for your family. If you've been telling yourself rates are too high, I want to challenge you to run the actual numbers for your specific situation. What's your rent? What would your mortgage payment be? What would you build in equity over time? What are you losing by waiting? We have an amazing cost of waiting calculator that we can share with you as well. And if you want help running those numbers, not generic calculators, but your actual specific situation, let's connect. You can learn more by hitting the link in my description. I'm wishing you all the best and we'll see you in the next one.